When older homeowners sell a property they've lived in for many years, some face unexpectedly high tax bills. Not from dishonesty or negligence, but from everyday family decisions they didn't realize had tax consequences. Consider a composite example. A woman in the Midwest owned her house for over 3 decades. She raised her family there, paid off the mortgage, and expected a straightforward, tax-free sale. Instead, she ended up owing over $20,000. The reason? A simple decision she made at home one afternoon, believing it would help her family. If you're over 60 and own a home, understanding these issues before tax filing deadlines can make a significant difference. This video covers 4 common decisions that can create unexpected IRS complications for senior homeowners. Then we'll discuss 3 lesser-known tax benefits that may apply to your 2025 return. Finally, a practical action checklist with steps you can take this week. Let's start with 4 areas that often cause problems. Think of them as HOME. H, home equity decisions. O, ownership and deed changes. Move out timing before sale. E, extra income from the property. If you find this helpful, please like and share it with anyone you know who might benefit. The example continued. Let's call her Margaret, a fictional composite based on real situations tax professionals see regularly. After her husband passed, her daughter helped with daily tasks. A neighbor suggested adding the daughter to the deed to simplify things later and avoid probate. It seemed sensible, so Margaret did it. No lawyer, no tax advisor, just a form at the county office. What she didn't know, transferring partial ownership of your home, even to family, can be treated as a taxable gift by the IRS. Depending on the value, it may require reporting, and when the home is eventually sold, the person added to the deed may not qualify for the same tax exclusion because they never lived there as a primary residence. Margaret learned this 2 years later from her tax preparer. The tax bill was entirely preventable. The IRS evaluates what was done and whether it was documented correctly. Intentions don't appear on tax returns. H, home equity decisions. Many assume that money borrowed against their home is automatically connected to the house for tax purposes. That's not accurate. If a homeowner takes out a home equity loan or line of credit and uses it for purposes other than buying, building, or substantially improving the home securing the loan, the interest generally is not deductible under current tax law. If the money went toward college expenses, medical bills, or paying off debt, that interest is considered personal interest and is not deductible. Claiming it incorrectly can create discrepancies the IRS may identify. If you've taken out a home equity loan or line of credit in the past few years, consider where the funds actually went. If they went somewhere other than home improvements, review this with a tax professional before the filing deadline. O, ownership and deed changes. Adding a family member to your property deed may seem like a simple family decision, but it can have tax implications. When you add someone to your deed without them paying fair market value, the IRS may classify it as a taxable gift. If the value exceeds the annual exclusion limit, a gift tax return, Form 709, may be required, depending on the situation. If that wasn't filed, there's a gap in documentation. Additionally, when you sell, the person added to the deed may not qualify for the primary residence exclusion, the rule allowing homeowners to exclude up to $250,000 in capital gains, $500,000 for married couples, because they never lived there. Their share of the gain may be fully taxable. There's also the basis issue. If you transferred the home as a gift during your lifetime rather than through inheritance, the recipient receives your original purchase price as their cost basis, not the current market value. If you paid $80,000 and the home is now worth $380,000, they could face capital gains tax on $300,000 when they sell. Had they inherited it instead, the basis would reset to market value at the time of inheritance, potentially eliminating much of that taxable gain. One approach costs the family significantly, the other may not. The difference is in the timing and structure of the transfer. Why April 15th? Matters. The IRS uses automated systems that cross-reference your tax return with third-party data, mortgage servicers, rental platforms, property records. The gap between what you reported and what the IRS sees has been shrinking. After April 15th, if something hasn't been addressed, interest begins accruing and penalties may apply. The first-time penalty abatement program, a real IRS policy allowing taxpayers with clean compliance histories to request penalty reduction, becomes harder to use once assessments are finalized. Acting early gives you more options. M. Move-out timing. This is often the most misunderstood. Under IRS Section 121, to exclude up to $250,000 in capital gains from your home sale, $500,000 if married filing jointly. You must have lived in the home as your primary residence for at least 2 of the 5 years immediately before the sale. This is the 2 out of 5 rule. Here's where it quietly causes problems. Say you moved in with family in early 2021 due to health reasons. You kept the house, tried to sell, rented it for a year, then finally sold in early 2026. You moved out in January 2021. Sale closed March 2026. More than 5 years since you last lived there. Under the 2 out of 5 rule, you may not qualify for the exclusion because both qualifying years fall outside the 5-year look-back window. If the house gained $200,000 in value, you could owe capital gains tax on the full amount. There are partial exclusion provisions for health-related moves under Section 121(c), but they require documentation and don't apply automatically. If you've moved out of a home you still own and plan to sell, count the months now. The window to address this exists right now. E. Extra income from the home. This one often gets dismissed because the amounts seem small. That's exactly what makes it costly. If a senior rents out a spare room, whether through a short-term rental platform, to a college student, or even a family member paying something modest, the moment your home generates rental income, the IRS treats that portion differently. 3 things change. That income must be reported on Schedule E. Informal arrangements aren't exempt. A portion of your home expenses may become deductible against that rental income, but without documentation, you face either audit exposure or overpayment. If you later sell the house, the rental portion may not qualify for the primary residence exclusion. The gain gets allocated between residential and rental portions. Depreciation recapture under Section 1250, taxed at up to 25%, can apply to the rental portion even if you never claimed depreciation. That spare room rented for a few $100s a month can affect the tax treatment of your entire home sale. Another composite example. Dorothy, a 68-year-old woman in the South, lived in her home for 27 years. In 2022, health issues led her to move in with her son temporarily. To cover expenses while waiting to sell, she rented the house for $1,100 monthly. She didn't report it the first year because her accountant had retired and her tax software didn't prompt her. The following year, her son added his name to the deed in case Dorothy's health worsened. No gift tax return was filed. Early 2025, Dorothy sold. After 27 years of ownership, she expected a clean, essentially tax-free sale. The IRS determined she had moved out more than 2 years before the sale. The rental period changed part of the home's classification. The deed change created a gift reporting gap. The unreported rental income was a separate issue. Dorothy owed over $23,000 across 3 separate issues, none of which she knew existed when she made the decisions. She wasn't negligent or hiding anything. She was managing a health crisis, a housing transition, and a family situation simultaneously without anyone telling her what she needed to know. The system doesn't adjust itself based on that fact. Now, the other side. Money you may be leaving on the table. Everything so far has been about problems. The next few minutes are about money that may be available on your 2025 return. 1. The senior bonus deduction. This is brand new and part of legislation signed in mid-2025. If you're 65 or older, you can now claim an additional $6,000 deduction on top of your standard or itemized deduction. It stacks on top of both. Married with both spouses 65 or older? That's $12,000 total. Available for tax years 2025 through 2028. Phases out starting at $75,000 modified adjusted gross income for single filers and $150,000 for joint filers. For many seniors where a portion of Social Security is taxable, this deduction can reduce taxable income enough to lower that exposure. It may not eliminate it entirely, but it can meaningfully reduce it, potentially saving $1,000 to $2,500 or more. Some tax software may not be fully updated. Some preparers may not be aware. Ask directly, did you apply the senior bonus deduction? If they're unsure, find someone who isn't. 2. The SALT deduction increase. From 2017 through 2024, the state and local tax SALT deduction was capped at $10,000. For homeowners in states with high property taxes, that cap was painful. As of 2025, that cap is now $40,000. For 2026, it increases further, rising incrementally through 2029. The phase-out starts at $500,000 in modified adjusted gross income, well above where most retired homeowners sit. Here's the issue. When the cap dropped to $10,000 in 2017, millions switched to the standard deduction and never looked back. 8 years later, the cap has quadrupled, but habits haven't changed. If your property taxes plus state income taxes exceed $10,000, run the numbers again. Add your total SALT to mortgage interest and charitable contributions. If that total exceeds the standard deduction for your filing status, you should be itemizing. If you already filed using the standard deduction when itemizing would have saved you more, you can amend within 3 years. 3. The energy credit. G. If you installed solar panels, a heat pump, battery storage, or other qualifying energy improvements in 2025, the 30% federal residential clean energy credit may still apply to your return for that installation. Legislation eliminated this credit effective December 31st, 2025. Systems installed and operational by that date still qualify. Systems installed January 1st, 2026 or later do not. The IRS has confirmed the cutoff is based on when installation is completed and the system is placed in service, not when you signed the contract or paid the deposit. If you have a 2025 installation and haven't yet filed, make sure that 30% credit is claimed. On a $30,000 system, that's $9,000. For future upgrades in 2026 or beyond, that federal credit is no longer available. Some states have their own programs, but the 30% federal credit is gone for new installations. One more thing. Property tax homestead exemptions. This has nothing to do with the IRS, so it's a state and local property tax benefit, and it varies by location. But for many watching, it may be worth more over time than anything else in this video. Almost every state offers a property tax homestead exemption for seniors. These aren't small discounts. In some states, the over 65 homestead exemption can reduce your home's taxable value significantly, saving some homeowners thousands of dollars every single year. Other states freeze your property tax assessment at the value it was when you first qualified, meaning even if your neighborhood doubles in value, your property taxes don't increase. Some states offer full exemptions from school taxes for qualifying seniors. Here's the frustrating part. These exemptions are not automatic. Nobody sends you a letter when you turn 65 saying your taxes just went down. You have to apply. If you've been 65 or older for years and never applied, you may have been overpaying. Some states allow retroactive applications going back 1 or 2 years, meaning you could get a refund on taxes already paid. Call your county appraisal district or assessor's office this week. Ask what senior property tax exemptions are available. Bring your ID and your deed or a recent tax statement. It takes about 20 minutes. For many people, that call will save more money over the next decade than anything else covered here. A quick word on scams. Every tax season, scammers target senior homeowners aggressively. Phone calls, emails, people pretending to be IRS agents saying you owe money right now and will be arrested if you don't pay by wire transfer or gift card. The real IRS does not call demanding immediate payment, does not accept gift cards or wire transfers, does not threaten arrest over the phone, communicates through official postal mail with a notice number in the upper right corner. If anyone contacts you claiming to be the IRS and creates urgency around immediate payment, hang up. Delete it. Report it to the IRS phishing hotline at phishing.irs.gov. The issues in this video are real. The people trying to exploit your fear about those issues are also real. Know the difference. Action checklist, 7 steps. This week. Step 1, pull your last 3 years of tax returns. Look at Schedule A for mortgage interest. Look for Schedule E, rental income lives there. Look for any Form 1099 connected to the property. Anything missing or unexpected? Write it down. Step 2, find your deed. Your county recorder's office can provide a copy, often online for a small fee. Check every name listed. If a name was added in the last 5 years and no Form 709 was filed, that needs professional review before the filing deadline. Step 3, map your residency timeline. If you've moved out of a home you still own, calculate how many months since you last lived there as your primary residence. If that number is at or past 24 months and you haven't sold, get professional review before the sale closes. Step 4, check your IRS account transcript at irs.gov. Create a free account. It takes about 15 minutes. You'll see every notice on file for your account and every piece of third-party data the IRS has matched to your Social Security number, including Form 1099-K data from rental platforms. If the IRS has information about your property that doesn't match your return, you'll see it there. Step 5, track your home equity records. Find documents for any home equity loan or line of credit. Write down exactly what those funds were used for. If they went into the house, you likely have a clean paper trail. If they went somewhere else, your return may need review. Step 6, list every rental arrangement the property has had, any amount, any arrangement, dates, and amounts. A tax professional can tell you what was handled correctly and what needs to be addressed. Step 7, contact a CPA or enrolled agent this week if you have any uncertainty after steps 1 through 6. The National Association of Enrolled Agents has a free directory at naea.org. Search by location and specialty. When you call, ask specifically whether they have experience with IRS penalty abatement for real estate issues. That one question tells you immediately if they're the right person. Dorothy did none of these 7 things. Not because she was careless, but because nobody gave her this list before she needed it. You have it right now. Use it. The cost of a professional review is almost always smaller than the cost of the problem it was supposed to prevent. Let's bring it all together. The 4 home traps. H. Home equity. Money from your house isn't automatically house money under IRS rules. O. Ownership changes. Adding someone to your deed is a tax event whether you intended it to be or not. M. Move out. Timing. The 2 out of 5 rule doesn't pause for retirement or health transitions. E. Extra income. Rental income from your home changes its tax classification, and that change follows the property all the way to the sale. 4 things working in your favor right now. The $6,000 senior bonus deduction available on your 2025 return, the SALT cap at $40,000. If you're in a high-tax state and still on standard deduction autopilot, run the numbers again. The 30% energy credit for 2025 installations that haven't yet been filed. The senior property tax homestead exemption, sitting unclaimed at your county office that could save you thousands every year. If even one of the 4 traps sounds familiar, don't file this away as something to think about later. That's exactly how people end up with unexpected bills on sales they expected to be clean. Start with step 1 tonight. The deadline is April 15th. By then, what could have been a quiet fix becomes a scramble. And scrambles are expensive. If this video helped you, hit the like button. Subscribe if you haven't already. Share it with anyone over 60 who owns a home. Drop a comment below. Which one of these did you not know about before watching? Your answer helps me decide what to cover next. In the next video, I'll walk through Form 709, the gift tax return that many seniors never filed when they changed their deed, and show you exactly how to address that gap before it becomes a formal IRS notice. If the examples in this video sounded familiar, that next video is specifically for you. This video is for educational purposes only and does not constitute financial, tax, or legal advice. Tax laws are complex and individual situations vary. Always consult a licensed CPA, enrolled agent, or tax attorney before making any decisions. The information here is based on current IRS rules as of 2025.